Chill out. Park it. Kick back, spark it. Welcome to the spot where money talks honest. Yeah. This is Gosh Talk with Bill Haase. Real life money in your front seat. From the paycheck to the profit. Turn that I don't know to I got this. Gosh Talk with Bill Haase. Blueprint stacked on the workbench. From the hustle to the harvest. Learning what they never really taught us. So if you're tired of the fine print winning, slide a chair in, that's a new beginning. We keep it straight, keep it smart, keep it classy. You're tuned in now, Gosh Talk with Bill Haase.
Today on our special show, Garage Talk with Bill Haase, I have my good friend, Mr. John Mackey, and his associate, J.S. Waldo. They are what I consider credit geniuses. And in fact, I believe that is that your website, John? I know it's your email address.
It's kind of my moniker. Yeah. The website itself is creditgd.us.
Okay.
And my Substack is creditgenius.substack.com.
Okay.
And then JS Waldo is JS Waldo, WHALDO. I spell it every time, JS, so I can get it right. And .substack.
Thank you. And we'll go over that a couple of times during the show to make sure. But welcome to the show. Thank you for coming on the show. You know, I'm a big passion person for financial literacy and you know, I want to help people understand money and their mindset on money, how money controls them, how they can get control back.
Yeah.
And one of the things I notice about most people are they look almost daily what their credit score is. And I kind of chuckle at that because I know better, because I know you and you've taught me well. Why is it tell me, is that credit score that you see, does that really have any meaning?
Well, yeah, it does. But, you know, there are so many misnomers about it. I just read yesterday an article by Investopedia, a well-known source.
Yeah.
Mm-hmm.
And they quoted your credit score as anywhere between 500 to 800. Now, I don't know how they could get it wrong, because that should be one of the very, very, very basic things. But yes, credit scoring, they've made it an integral part of our life. They, meaning creditors. And they can get much more work done if they have a single digit to look at rather than having to look at an entire credit report. And as an underwriter, I'll let JS take over there because she looks at it all the time.
It's the beginning. I mean, the credit score is the beginning of everything. And as far as a mortgage underwriter, we have 3 scores. And obviously, with all 3 scores, we don't use all 3 scores. We use the middle score. And as John has taught me, there are lots of different scores, but the ones that the mortgage uses is, you know, whatever they buy. And yeah, it's everything. It's your starting point.
I get that, and I appreciate your perspective, JS, because I spent 4 years processing and underwriting loans myself, and I'm kind of familiar with how they, you know, take a score. But let's be real. If I look at my bank account and it says I have a score of 750, and I go to borrow money, why does it not come up as 750 anymore?
Well, because there are so many variations within it, and we have to know what they're judging. We have to know, you know, is it revolving debt? How much do you have in revolving debt? Did you charge something up that month? We have to know the history of your credit report. That's why typically older people have better scores than younger people, You've got a
Yeah.
longer history.
But
So
more than
it's
that, I think it's the
yeah,
model. It's which one they're using. That's the point that most people don't realize. You know, like John talks about FICO 10T a lot, but that's not
Hmm.
what mortgage companies, that's not what that's not what actually most lenders use, you know. And a lot of people are using Credit Karma, and you look at the Credit Karma score, and that is nowhere near what the models are being used by the different creditors out there. I think that's the real answer. You really, which model are they using? That's the big question. Which model is everybody using?
And that
and what
makes
product are you attempting to purchase?
bingo. And that's what I was just about to bring up is it does. If you're getting a loan for a mortgage, it's one way. A car is another way. Maybe HELOC is a different one. It depends on what you're borrowing the money for, right?
Yeah, it does. I'm going to go back
Mhm.
to an analogy that I used many years ago. And that was we took a snapshot of one individual on one day, one bureau, meaning one credit bureau report. And we ran it through FICO 2, 3, 4, 5, 6, 7, and 8. Ran them through them all. And her score, based on the same data, ranged from 683 to 620.
Hmm.
So
Wow.
it depends upon what you're purchasing. Mortgages are FICO 2, 4, and 5.
Yeah.
Well, why wouldn't you use the most up-to-date information? They don't. They don't. They're morphing to that, but it hasn't happened yet.
Well, let's be clear now. FICO 2, 4, and 5. You say, for those in the audience, those are processes that are used to determine your credit score,
Correct.
right? And 2 being an older model, right? 4 and 5 are newer models. But there's models all the way up to what, 11, 12?
No, FICO 10T is the most recent.
10T.
It's
Okay.
come out, but it hasn't come out for the mortgage market.
Yeah.
So they're not using it for the mortgage market. They're only using it maybe for credit cards. And that's such an alien concept because for FICO 10T, they take a look at your last 2 years more highly. They don't
Okay.
take a look at us as a snapshot, which is what it used to do. Okay, so instead of taking a look at it and you say, okay, I'm going to go buy a house, so I'm going to drop down the credit card debt. My credit card debt has been at 90% for the past year and a half, 2 years. So what are we going to do? We're going to pay off that credit card. And then boom, the snapshot comes back. You go up 100, 110 points.
Okay.
But now with FICO 10T, they're going to average it over the past 2 years. So that bump won't happen.
That's interesting but that also, in one way, I like that idea because if I had trouble 5, 7, 10 years ago, say we were in the housing bubble time, that's not going to be as reflective, right? That's not going to stand out as much.
Yeah. Yeah, you're
So,
right.
so
You're
that can
right.
be helpful. But again, you're talking about, it's more helpful, I think, to older folks. Um, but there's still there's a lot of things involved with credit scores, right? I mean, they don't just randomly have a calculation comes up with a number.
Well, it feels like
What's
it.
all
It
involved
feels
in
pretty
coming up with
random.
that one number? Yeah, well, I can agree with you after, going through many loans myself and then underwriting and processing many loans over a
Hmm.
4-year stretch. But um, and I love where you're coming from, JS, because a lot of people don't understand that they look at their credit reports and like, oh, but I only have like 10% of my credit card being used. Why are they holding all of this against me? It's like, well, if you're cleared for $20,000 on your credit card and you're only using $2,000 of that, you still have access to $18,000.
Hmm.
That's precisely my argument.
Hmm.
Yeah. And that's held against you when you're getting a loan, right? Because you could really find yourself in a lot of trouble. Let's be honest. Most people, when they buy a home that probably costs more than they should be paying, buying for.
Yeah.
Not
You
exactly.
get pre-approved or pre-qualified. Pre-approved and pre-qualified are two different aspects of a loan, right? When you're going
Yes.
out, let's say, to buy a house. And, let's say you get pre-approved or pre-qualified at 250,000, but a realtor shows you a $320,000 home. And you fall in love with that because it's got the bells and whistles that the $250,000 home doesn't have. And then you learn, well, it's only going to be $300 more a month, let's say. We can figure that out. We can make that happen. And
Or
she,
maybe the loan officer says, let's shoehorn them into a negative AM type loan, which is what happened back in 2008, a negative amortization, meaning they
right.
start off where their actual balance is increasing after they make their payment.
Yeah, that's interesting. I did not do any of those loans.
Didn't you? That,
No.
that was a big issue here in certain communities in Minnesota. Uh, Whole towns went belly up because of those negative AMs. It was new construction.
Hmm. Very interesting. JS, what are some of the other aspects of FICO score, affects how that affects these loans, the loans you do?
Mhm. Yeah. So, like I said, it's a starting point, and for underwriting for mortgages, at least A paper. There's different types of loans. There's A paper, there's B paper, subprime versus prime, and I've done both. I mean, everybody is literally because you have no choice, but it's your starting point,
Right.
and different lenders have different guidelines. Some lenders will only do A paper. Some lenders will go all the way down to, let's say, like FHA will accept as low as 500, credit score of 500. So now what you're talking about is you're talking about basically throwing out the score and doing an old school underwrite, which you're looking at everything. You're looking at everything. So you have automated underwriting. Let's be real about this. Automated underwriting looks at credit score first. And if you're at a certain point and you have certain debt ratios, everything else, you don't even need an underwriter. It's approved and it's that simple. But the fact
Right.
is, people don't fall into that box. It's such a tiny little circle, and most people are not fitting into that circle. And so now you're talking about a true underwriting, which is looking at your income and your assets and your true credit history, not just this number. And so that's why I say it's just a starting point.
Yeah, no, I totally get that. We have a lot more entrepreneurs than we've had before, which makes it more challenging to underwrite them. I had a friend of mine who was the head of uh, Morgan Stanley's. He ran half the country's underwriting and
Hmm.
lending. And he would have gentlemen that would or people that would have 27, 30 businesses. And
Right?
how do
I've
you
had that too.
underwrite that?
Yeah, I mean,
Yeah,
that's
I
literally when you pull out the big board and you start making notes. You're literally, for me, I always made spreadsheets because those are the people I underwrote. Those, when you start in this industry way back when, you were used to underwriting by literally manual. It's just called manual underwriting. And you literally had to analyze every single business and all the sub businesses and this business on this business and on and it went. And it can be extremely complicated. Most underwriters these days, unfortunately, don't know how to do that. So they kind of rely on a
right.
certain percentage of us who started with that, and you're the ones that you get all the more difficult ones. But here's the thing, again, when you're talking a credit score, You could literally have the most perfect borrower whose credit score just tanked because they had one medical collection, and now they're suddenly
Mm.
at 585. In every other respect, they're the perfect borrower. So the FIFOs are
So,
so misleading.
well, let's hold on there. When I was underwriting, we didn't take any medical debt into account.
You don't. But again, that credit score is your starting point, because depending on what type of loan you're getting and depending on what you're trying to buy, right? So if you're buying a primary
hmm
residence, that medical has nothing to do with anything, but it just tanked your score. So now you need an underwriter like me to come in and say, oh, you're really not a 500 or 580 borrower. You are literally an 800 borrower, but your credit score doesn't reflect that because that medical collection just jumped in and tanked your score. So although we do not care about that medical collection, the FICO score takes it into effect.
So, John, how does that affect your credit score? How does that affect a loan?
Well, it used to be that it would affect the loan. Then they took it out where nothing affected the loan. However, that's for the new FICO 10T where it doesn't affect. But they're not using FICO 10T for mortgages.
Well,
They're
don't you, with a lower score,
you,
you're going to pay a higher interest rate.
they could, sure,
Okay.
Mm-hmm.
And
Um,
again, that's not my forte.
and
My forte is trying to explain what happens. And what's interesting about this is I just did a Substack post on this regarding medical debt. And in some areas of the country, medical debt won't go on a credit report. However, a debt collector can still sue them.
okay.
Okay. And when that happens and they get a judgment, therein lies part of the problem.
That will then show up on your credit report, I presume.
Correct. But in my point here with this is I wanted to take a look at an analysis and see. I wanted to find which one nationally, be it revolving, installment, medical, what kind of debt are most people being sued on? My assumption was that it was revolving debt, credit cards, and it wasn't. It's
Really?
medical debt,
Well, I knew it had to be one of those two. Look,
right?
we've had stagnant wages this year, right? And yet we have record amounts of spending. And we have
Because everything is going back onto credit cards.
right.
Take a look at the Christmas and why I wrote this new course. I'm just going to mention it's called Debt Collectors' Lies, Damn Lies, and Deceit, where we talk about how debt collection is going to morph this year. Debt collectors are coming out of the woodwork right now. And
Mm-hmm.
because of the disbanding CFPB, they are being, debt collectors are just saying, there's no cops. We can do what we want. And that's what they're doing.
Yeah, it's crazy what some of the things that are going on. But one thing that drives me nuts is the commercials that, the guy says, oh, I'm $59,000 in debt and it would take me 62 years to pay it off if I made minimum payments. And I go to this place and now they take off 30 grand. I only owe 29,000. And I'll be out of debt in the next 2 years.
Right.
It's like, okay, I'm thinking I'll do that all day long. I'll buy $60,000 worth of stuff and only have to pay 30,000 back,
You will for a short period of time because that debt, you're talking about negotiating debt, and the credit reporting system treats those as if they were bankruptcies when you go into debt negotiation.
Okay.
Correct. It actually shows
That
like
makes sense,
that on your credit report.
Okay, but after the housing debacle, everybody who lost a home technically That's a form of
Mhm.
bankruptcy. Um, and technically, you would historically, I thought it was 7 years before you could really restore your credit level and get back into a loan and buy a new house.
Well, yeah, and bankruptcies, typically, they can stay on your credit report for 10 years. That's the one caveat beyond the 7 years that it can
Okay.
stay on a credit report. So a,
But
debt
but from
collection, or
but
judgment.
sure, but
Go
for
ahead.
mortgages is that's not how it works with mortgages though. That's totally not how it works. With a mortgage, you could be
Okay.
2 years out of a bankruptcy and your FICO score, sure, that's again your starting point, but that doesn't disqualify you for a mortgage. You could be in a chapter 13 as long as you're 12 months in and have made all your payments correctly, you can get a mortgage. This is a fallacy. This is not correct. This is what I write about. People believe this and so they
Okay.
don't even try, but it's not
Yeah.
true.
Yeah, I'm glad you bring that up, John.
JS, isn't that just because FHA you can go 2 years, but I think conventional is longer than that, isn't it?
Conventional will do it as long you can still override the system and do a manual override. And conventional, you can still be in a chapter 13 again, as long as you've made
Right.
all your payments, and you get the trustee's approval. There are caveats to every single rule, but again, these are old rules that people keep talking about, and it's actually not completely
Mhm.
true.
I like hearing that. That can help a lot of people.
It can,
Um,
and that's why
and
I
I
write what
think
I write about.
Right.
no, and I appreciate that because I think when we have a record amount of debt, credit card debt right now at record high interest rates,
Right.
that's a bad combination. That is
Mhm.
not a good economic viewpoint going forward. And I spent 16 years in interest rate futures at the Chicago Mercantile Exchange, so I understand the housing market. And I understand these numbers, and it doesn't look pretty. I'm not saying that the economy is going to fall apart by any means. There are many other things that keep an economy going, um, but that's a scary thing. I mean, because people don't understand. Uh, Credit cards, it could be 28, 30%. Cash app loans can be 300%. If loans against your wages can get upwards of 600%
Mhm.
in
Yep.
some instances.
Yep.
These are crazy numbers. I mean, who in their right mind would spend $1 and owe 600 back?
Desperate
But
people who
Well,
are living paycheck to paycheck.
which is 80% of this country.
That's right.
It's
yeah.
about 78 to 80% of this country lives paycheck to paycheck. And you're right. And that's another pet peeve of mine, that all of these apps and things are targeting the people who are going to get hurt the most and
Yeah.
and they understand the least. Um,
That is
it
absolutely correct. And that's one of the things that John and I talk a lot about. We talk a lot about we have our podcast, Give Me Credit, and we both write about the buy now, pay laters. We both write about
mhm.
from the mortgage side, I look at like all the loans that I see that don't show up on the credit report that ultimately can kill an entire mortgage. John and I talk about how these traps are laid, and the entire thing comes down to credit education.
Absolutely. I was just going to mention that. And therein lies why the three of us together are speaking about this today, because Bill, you wrote that book, marvelous book.
Hmm.
Love the book.
Yes.
And
Thank
talking
you.
about the mindset of and then we're talking about the mindset of credit scoring or debt collection or underwriting, because they all fit together.
Hmm.
It's all the undermining. You know, so many people spend so much time trying to figure out ways to pick your pockets, right? To pick all of our pockets
Legally.
legally. A lot of energy is spent illegally as well, but if they'd only put it into the legal side, it'd be great. But people do not understand how money works. They don't understand. They don't understand how credit works.
Yeah.
Right, to their advantage. It's funny because you see commercials especially car commercials, 0% for well-qualified borrowers. What's a well-qualified borrower?
That's up to them at that time when
Exactly.
Yeah.
They don't
Yeah.
tell you.
it could be over 800 in the score.
Yeah. I would think you'd have to be, right at that 850 mark.
Yeah.
What's the
Yeah. And
average new car payment?
The
I
average new
see
car
it.
interest rate?
Yeah. What is that?
It's over $750 for the car payment.
Well, so there's right now cars just broke the 50,000 mark for the average price of a new car for the first time ever. And 20% of those loans are for $1,000 or more monthly payments.
Yeah.
And people don't realize they when they buy a car, they say, oh, I'm looking to, the first thing you get asked is, how much are you looking to spend? And you say,
Yes.
I want to spend no more than $300 a month on a car. Somehow you wind up spending $400 a month on that car. And you justify it saying, it's $100 more a month. I can squeeze that out. But people don't look at it. It's 48, 60, 72, months.
Yes. And they've now just expanded it to 84 months.
And
Yes, they
84
have.
months. And what happens to a car is it loses its value by 50% in the first 3 years. So now you're underwater, right? You owe more money than your car is worth.
Right.
And anybody who's been through the housing bubble knows what that feels like.
Yeah.
But there's more to this than that. There is. There's
Okay.
so much more to this. And this is where I think that I get really passionate about it. I know John does too. People are truly struggling out there, and they're sold an idea. Let's be realistic. I'm sitting there watching football with my husband, and all of a sudden an ad comes on and their water heater just broke, and that's okay because we got you over here. We can get you cash in less than 5 minutes and you got your water heater back. That's predatory lending. You are talking about 30% interest rates. They're taking payments every 2 weeks, and they're in a desperate situation and they have nowhere else to go. And it's predatory. And that's where I get very emotional, because those are the people I find that would pay their housing payment till the end of time first before any single thing else. They would literally
Yeah.
beg their mother to watch their kids because daycare is so expensive. And I get quite emotional about that because it's predatory lending and it's everywhere and it's not being checked, and I hate it.
I'm with you 100%, 1,000%. And it goes even, here's another commercial I can't stand. A young man at the grocery store, and he's online, and the gal's ringing up all his food, and he looks and realizes, oh, I only have $4 in my account, and it's cha-ching, cha-ching, cha-ching as food's being rung up. And so he quickly downloads an app and borrows, $500. And he goes walking out of the store with the food. He's happy as can be. And it's like, do you have any idea what you just did? What the damage is done. Now,
And so again,
yeah,
you're
'cause
talking about
look,
predatory lending to survive.
yeah, there was a commercial that showed a kid inside a vending machine, and he said, feeling cramped and stuck with, not having any money, just download this app, borrow the money. Next thing you show, it's a picture of him sitting at the table with all the food from in the vending machine, and he's happy as can be. It's like, you borrowed money to eat crappy food, and you initiated a new form of debt or the couple that's sitting in the kitchen and the wife is saying, "Oh, we're out of money and the bills aren't all paid." "Oh, no problem. We'll just download this app. We'll borrow the money. We'll pay it off." Well, what are you going to do next month? Because if you couldn't make it this month, your bills aren't going to be much different next month, and now you have an added bill on top of it.
Right.
This is what bothers me, because I agree with you. I think it's predatory lending. And they keep finding new ways to do it. The buy now, pay laters. Really?
Yeah.
Those aren't even allowed in a lot of countries. Neither are these cash apps. A fellow
Well,
author
what are
friend of
they
mine in
doing
Australia
with
says we got rid of those years ago.
what are they doing with that information that they're gathering? It's all a gathering device.
Right.
That's what it is.
Right, because we sell the information.
Yeah.
Mhm.
Why do you think every fast food chain now wants you to sign up?
Oh,
Be
yeah.
a member. We'll throw something free to you every once in a while.
Yeah.
It's it's a crazy world, but the credit score seems to grab our attention consistently, right? We're constantly looking at it to see how we rate. It's a
I think
judging tool.
I'm going to challenge you on that. I'm going to say most people don't even know. They don't
Yeah.
go online to check their score. They might get it from Credit Karma setting it up.
Yeah.
They're not getting a credit score. They might get it from a TransUnion report that their bank, Wells Fargo, gives out. But that's based on what? Vettage?
I get it from my two banks, my personal bank and my business bank.
Right.
And they're two different scores.
Mhm.
And I'm just like, I don't know what these mean. I know one thing. If I go into that bank and say, you have me at 700, I want to borrow money, and then they come back and say, yeah, but you're really only 640. Well, no, you just told me I was 700.
Right. But
So
they're not pulling from that company.
yeah, right. And why won't you lend to me at what you told me I'm at? Predatory lending.
It
They're
is,
just
and
trying to
not just
get you in the
that.
door.
Exactly. And so, like, you have the Credit Karma, you have every single credit card that offers you this score. You remember it used to be just Discover. Hey, come with us and we'll give you a credit score every month. And not just that, but as soon as you get that credit score, by the way, you qualify for this, this, and this. Come on, consumers, let's spend every single dime and then let's charge you 30% interest rate.
Mm-hmm. Or I love that going to the store. Hey, we'll give you 20% off if you sign up for a credit card right now. Oh, and by the
Yep.
way, you can put it on that credit card today, so you can walk out of here without spending a dime, and you feel like you just stole everything.
Yeah,
And so you wind up buying twice as much as you intended to buy.
exactly. We literally wrote articles about this. We did our podcast about this, especially with the holiday season. You're at Old Navy checking out, and they're offering you theirs, and then you go over to Marshalls or Kohl's or something, and then they want you to do it too. And
Yeah.
John, you and I have done the analysis. You go into the holiday season with a 700, and you walk out with a 620.
Yeah.
Yeah, that is crazy. Yeah, I was trying to remember talking to somebody about they were very concerned about their score, and I said, "Well, why are you so concerned?" "Well, just because I think it should be higher." And it's like, "Well, are you planning on borrowing money anytime soon?" "Well, no." But we don't plan it. But life happens, right? That water heater goes out, the furnace goes out, the air conditioning, you get in a car accident, you have a medical issue. I mean, life happens and it hits us, and all suddenly we're scrambling to figure out how we're going to cover these costs.
Well, Bill, we've been brainwashed. Let's just come down to the true fact. We've been
Mhm.
brainwashed into buying things that we need. Things
Oh,
that
from
just
the get-go.
don't matter.
Well,
When
John,
I
you've heard me say, money is with us from pre-birth to post-death, and yet we do so little to learn anything about it.
yeah.
And
It's
they
crazy
don't
because,
teach it in
in fact,
school.
no, and you know what? We're not supposed to talk about it. It's taboo. You know, I as an advisor, I used to meet with people and speak in front of groups, and I'd say, um, look, there's two things I know spouses almost never talk about, and it's money and sex. And if they're not talking about money, they're not teaching it to their kids. You send them off to college, you give them money for the semester. They call home a month later saying, "Oh, I spent it all. I'm sorry." And and so you give them more money as a parent, and you say, "You really need to learn how to budget your money." The same parent who's not doing that and didn't teach you. And you wonder why we have problems. And it's not just here. It's all over the world. It just, money is taboo to talk about. But we love it because we can use it to make ourselves look smarter and wealthier than we actually are. And why do we do that? We're willing to go into debt.
It's all about the guy next door, comparing yourself.
Yeah,
It's all about status, social status.
The
you're right.
psychology around
You're right.
money is it's literally here's the bottom line. These companies, and these companies I'm talking about all the way from the big banks to the retail companies, marketing is psychological. It's psychological warfare, and they literally use it against you. They know how we feel. They're playing on your emotion. They're playing on the guy next door,
Mhm.
but they're also playing on you're not successful and you haven't made it in life if you don't have this, this, and this, and you can't spend money and you can't have this car. You have not succeeded in life. And they have all of this psychological warfare, as John has written about, the data mining. They know all this stuff, and then
Yeah.
they target, and it hurts you in the long run. And until you get past that psychological warfare, you can't even slightly start to understand money. But that's how the system is made.
I agree with you. And John has done many tremendous things to help educate folks. So, John, how do we find you? How do we educate ourselves through your efforts?
Well, I think the easiest and the quickest way would be to go to my Substack post. And it's creditgenius.substack.com. And it's all one word, creditgenius.substack.com. And I write on a lot of information. And as Bill, you know,
Yeah.
I write a lot.
Yes, you do. Yes, you do. I can attest. I give you a hard time about it. I don't even know how you can do as much as you do.
Well,
But you always have
getting
great.
old, I've got to get this information out there.
Yeah, and it is great, wonderful information. And JS, how do we get in touch with your work?
I am also on Substack. I am jswaldo.substack.com, and it's JSWHALDO.substack.com. And yeah, I'm more towards the mortgage side and credit and how it works. John has so many great articles. Even I, as an underwriter, have learned so much.
Yeah, I've grown tremendously in my knowledge of the credit world through John, and I highly recommend folks get out to these two Substacks because you got to start learning. You got to do something. You got to make an effort. The
Yeah.
point is to make your life better, to live a healthier.
When the cops aren't around, we need to start protecting ourselves.
Yes.
And the CFPB is no longer here, really. And so we need to learn how to protect ourselves. And this is what we all do, all three of us here.
Well, you know my favorite question. Do you live your life with intent or by default?
Yeah.
And when you live financially by default, that would scare me to death. You have no say when you live by default.
Yeah.
And the predators are out there, and they're going to take advantage of you, and they know the numbers.
Yeah, they do.
And it's there's just, again, so much you can learn from John at Credit Genius at Substack.com, and JS Waldo, WHALDO .substack.com. I highly recommend you going out to those websites and start learning, start teaching yourself, because you're going to be amazed at what you learn. It's shockingly good information, um, but it's you might get a little scared at the beginning, but the
But
more you
that's
learn,
standing up. We just need to stand up.
yes, yeah, you got to fight. You work hard to earn it. Why wouldn't you fight just as hard to keep it?
Yeah.
So, or to use and learn how to use it properly. And you know, one thing we've learned, even going into businesses, is if you teach the employees financial literacy, they wind up staying longer. They wind up being more productive, healthier, happier, better relationships.
Yeah.
I mean, what's wrong with any of those things? And that's because they learned about money.
Mhm.
So
Yeah.
do something
Thank
about
you,
it.
Bill.
So I appreciate having you both on. Thank you so much. Filled with such great information, and definitely going to have you back soon.
Thank
Great.
you.
Thank you,
We'll be
Bill.
glad to.
Absolutely.
Thank you
Thank
both
you.
so much.